guys, Alex here. Hope everyone's well. I'm just going to do a trade recap today, going over a few trades that I took towards the end of November. There were 3 trades on EU, so there was 1 short and 2 longs. Because during December I've not taken as many trades really. I'm kind of slowing down towards the end of the year, and there's still quite a few kind of trades that I took during November that I've not actually covered yet, and so I thought I'd do a few today. And so just kind of following on from the last recap I did on EU, took a short up here and we kind of followed the trend down, ended up turning into a bit of a beast, to be honest. But yeah, so now we're coming into this weekly supply and demand flip zone. We can refine it onto the daily like I have done here. But essentially all we need to know from the higher time frame perspective is that we're bearish and we're coming into what can be considered a pretty significant zone, which we are quite overextended, so there could be an argument for potential pullback from these areas. So as you can see, it's just the typical flip zone. We have our weekly supply here, we have our reaction point, our extreme of reaction leg, and our failure. So the extreme of the reaction leg on the weekly being this inside bar, and then if we go down to the daily, you can kind of see it's a little bit messy over here, but basically it's just the refinement, the very extreme of the reaction leg being these wicks. And so if we just look now to the right, if we go down to the 4 hour, we can see just coming into this zone, we've basically put lower low, lower high. This failed to close below, so this isn't really a confirmed swing structure. We now do have a lower low here. And so typically what you'd expect now is just some form of pullback, some form of correction, pulling back potentially into the premium of the leg to then potentially continue. Or if we are going to turn around from these areas, from these higher time frame demand zones, we may just get some reactions from these areas and then continue towards the upside. And so if I just go down to the 15-minute, because basically the 4 hour, there's not an awful lot at this point in time that is telling me, other than the fact at this point in time we're reacting to something here, but I want to get into that on the 15-minute. So let me just go down a time frame. So you can see here on the 15-minute we did close below, but of course on the 4 hour we didn't actually close below. Now, at this point in time, we are kind of within this weekly demand zone, right? And so it's not ridiculous to expect a potential pullback now from these areas. We can say we've potentially swept the liquidity below this structure here, and we've essentially had this 15-minute change of character to the upside. Now, the key thing I want to talk about here is knowing when a demand is taking control over a supply or when supply is taking control over a demand, right? Because it's just simply not enough just to see a supply failure. If we have, for example, the last point of supply that caused price to trade lower than this, we'd say likely would be this area here, right? And comfortably we've broken this area here. We've had this break here as well. But essentially we've broken supply. But this isn't enough for me to confirm or to have confidence in knowing that demand has now taken control of the market. Yes, we're within an overall demand, and yes, we've had a supply failure, but the key thing is not only do I want to see supply fail, I also want to see the demand that caused the supply to fail to also hold afterwards. And so like in this case, I'll just zoom in a little bit, you can see we've come into this supply, we've got our typical flips, we've got our reaction point, our extreme of reaction leg, and failure. And so we basically have, in this case, just one candle. But basically we have our level of demand here. And so if we were now to consider us, or demand to be in control, realistically this demand should hold. And the fact that it's not, is we've just, we've reacted to it and we've blown through. It's telling me that, okay, yes, we've broken structure, but what's in terms of supply and demand, we've not really had a shift or a confirmation of shift in order flow just yet. So I preach about it quite a lot in using the structure in conjunction with supply and demand and not just using one in isolation. Because yes, we could just say in terms of structure, we've broken this, and we might argue that yes, we're going to break this demand, maybe to come lower into this area of demand down here, for example, something a bit like this, and then continue because we've had this break. But if we factor in the supply and demand, we can see that we can kind of anticipate what is actually going to happen based on what is currently happening. And so at this point in time, we've come into this area of demand. We have our typical reaction, extreme failure. So in this case, this inside bar. And so we have our failure of the reaction, or if you wanted to wait for the demand to break, you could do. It's fine either way. We can say that this supply now we've taken the orders out of this area of demand. It wasn't enough to continue pushing price to the upside, and supply has actually overpowered demand and regained control. Or has it? Because like I said, not only do I want to see demand fail, but I also want to see the supply that causes the fail to hold, to confirm the shift in control. And so in this case, the key difference between this and this is this. Not only did demand fail, but supply actually held as well. So we can say with confidence, yes, structurally we've broken to the upside, but supply is in control. Demand never actually took control, it just broke one supply. Supply is actually in control of the market, and now we can begin a potential supply chain. And yes, we're going to react to these areas of demand because they did break something, but then this is typical of building liquidity, where demand reacts while supply is in control, and all we're doing is essentially building liquidity for lower prices. And so if I just follow this on a little bit, you see that we've basically have this supply chain here, and we eventually got on to break. So we now have this break of structure to the downside. And so in terms of, let's clean this up a little bit, in terms of 15-minute structure, you can say yes, we now have a lower low, lower high, we have another break here, and lower low. In this case, this is actually a failed attempt at a lower high because it fails to close below the structural low. We've just wicked it, so this isn't a confirmed lower high, so our 15-minute high would still be here at this point. So something a bit like this. And obviously breaks of this then would just be breaks of internal structure. And so I did mention about this. So this here, like I say, it was a supply chain. I mean, I could draw them up, just to make it more visually noticed, but basically we have this, say that this has mitigated this, and we essentially have this supply chain here. But structurally our 15-minute swing high would be here, and so it would be valid to consider potential shorts from this area, as it is basically the extreme 15-minute supply of this structural leg. But what we can see here, we didn't have anything in terms of structure to the left, so there was no available liquidity to take to the left, and so the idea would be we need to build some to the right. In this case, we just shot straight into the zone, didn't build any to the right, and so the idea then would be we need to take the high. The high would have to go, if we were to look for shorts, from this area in order to follow through. Based on the liquidity concepts that I've talked about quite a bit in previous videos, this high would be the only available option to grab liquidity and then essentially fuel this move to continue lower. So in this case, if we were to get confirmations here, it would be potential or valid trades in terms of selling. But for now, I'll just mark on what we're seeing. So basically what we do have at this point, we have the reaction to this area of supply, the extreme of the reaction leg being this 15-minute demand that then goes on to break structure. And so, okay, where is the next available possible area for shorts? And like I said, we have this 15-minute supply zone up here, and so it's a very key area of interest. Okay, now the next question is, what are we doing in terms of liquidity? We want to be prepared in advance before even arriving at this zone in terms of knowing what to expect. Do we need to build more liquidity or not? And so we could argue that potentially this was inducement for this zone. We could sweep this and mitigate this zone, but it's not just as straightforward as we're going to use this for this. How are we trading through this zone? Are we sweeping it, mitigating this, getting our entry and going, or are we just continually sweeping it, trending above, and just trading literally through or above the inducement? And so in this case, this is the area here. You see, okay, we've already, let's grab this out. We've grabbed the liquidity here. We've already grabbed it. And that little move there was essentially this liquidity being used in action. And so if then I wanted to sell from this zone, for example, if we came up higher, I would then consider ourselves to have no more available liquidity to the left, because essentially this has already been used here. So let's play it on one more. We've already used the liquidity above the structure to the left here, and then continued to trade above it. And so there was nothing else to take to the left. And so even though we had this area here, I'm still going to go off the premise that there was nothing available to the left because this was already taken, and now we need to build and take more to the right. So either prior to mitigation or post mitigation, if I was to look for shorts, from this supply chain. And so if I go down to the 1 minute, we can ask ourselves, okay, where was the last point of demand before the mitigation of supply? In this case, we mitigated supply here, so we follow it down. We have this, this nice inside bar here. It's kind of, last point of demand. And so at this point in time, I'm considering us to have not taken liquidity to fuel the move. So I'm not looking to enter at this point in time. Even though we're within the zone, I want to see liquidity being built and then taken. And so if I just play this on a little bit. So we've reacted to the demand zone, we've pushed up a little bit and then failed, right? So we essentially have our flip zone. Our flip zone here. And so although it's a valid flip zone, we've mitigated this level of supply, and arguably you might have thought that we were taking this liquidity above here to the left. For me, I'm considering it to be already taken here, and now we've traded above it, so like I said, I want more liquidity to be taken. And so for me to enter here, I'm not looking to set a limit just yet. What I want to see is liquidity being built, taken, and I want to see supply hold. Like I mentioned a bit earlier in the video, not only do I want to see demand levels break, I want to see a supply hold first as well. I want to see our first level of respect, essentially. So in this case, I want to see this level hold before I'm looking for shorts. So I'll just play price in a little bit. So now we could say that this could be used as potential inducement for this zone. This is the supply which caused the demand failure. This is our flip zone. This is hovering just perfectly below it. It's not miles away from the zone. It can be perfectly taken really fast, literally just swept and gone like that. It's not all the way down here where we'd need to trade through it in order to grab it, in order to grab the zone. So I'll just play it on a little bit more. See, this looks like a perfect time to, set an order, and this will be a perfectly valid trade, because essentially it has the things we want. It has the mitigation of supply, it has the supply and demand interaction flip zone, it has inducement. So although there was nothing available to the left here, there was nothing built here prior to mitigation, now we've had the mitigation, we do have available inducement before our zone of interest for entries. The only thing we don't have is a level of respect showing supply is holding. And so this is why personally I didn't have this order on just yet, but this would be a perfectly valid trade to take. I'll just play on a little bit. Okay, so we've come into the supply flip zone and we can see that it's starting to hold. And so now all I'm looking to see is, now that the supply that caused the original demand break has held, I want to see, okay, where is the next level of demand prior to mitigation? And so in this case, there was kind of two. We had, this one was kind of the more obvious one that I was most interested in, to be honest. But there was also an argument for this little wick here. So I want to keep an eye on that as well. But basically what I'm looking for now is, I wanted to see this this demand fail. So we have our reaction, which is nice, and our failure. So this was the typical flip entry that I was considering. Now the key thing here is, there was kind of two areas of interest here, and so this is kind of where I didn't want to be too greedy. I wanted to make sure I get in the trade firstly, so I actually had my entry covering this whole zone. And the next thing is, I wanted to I was a bit cautious of this being potentially the last point of demand before the mitigation. The reason I favoured this one was because it was the last point of demand, which caused price to trade higher than these structures. But either way, I actually wanted to make sure I covered this, essentially this little wick, reacted to this, pushed up and then broke. And so I didn't want to be, too ridiculous with the stop, something like this. I wanted to cover both. I think I had a 2.5 pip stop, something like that. Essentially covering both areas, making sure I'm in the trade and making sure I'm protected as well. And so why is this a good trade? Why did I take this trade? Just recap a little bit. So this was taken, this liquidity was taken above to the left, already taken here. We continue to trade above. We mitigated this level of supply from our 15-minute supply chain here. We then had last point of demand, so we had our reaction, the extreme of the reaction leg, the failure. We'd taken no liquidity here, so we needed a post-mitigation inducement like this, which was perfect for the zone. Then wanted to see the level of respect. I wanted to see that the supply was not only breaking demand, but I also wanted to see that it was holding. So in this case it held, it then reacted to this demand and then broke. And now I can enter on this supply, not hoping that supply, or not presuming that supply is in control. I've had it confirmed to me with this. I've waited for this level of respect, and now we've had another break of demand, and so this for me is a much safer entry, although this one was still really valid and really good. But yeah, so this was essentially my entry here. And then in terms of targets, we had this 15-minute level of demand. Essentially we could say that the 15-minute technically had to break bullish here with a body closure. We broke above the 15-minute high, which was this, and so we could say the 15-minute is actually bullish at this point. So although the 4-hour and the higher time frames are bearish, the 15-minute has switched bullish, whether temporarily just in order to grab liquidity to mitigate this to then continue lower, or potentially now we would start a 15-minute intraday trend, would remain to be seen. But basically we had this 15-minute level of demand, and what I could see straight away is the fact that there's no structure within this leg, similarly to this. And so I wouldn't expect this demand to hold unless we built more liquidity to the right. So if we were to come down here, I wouldn't want to long off this because of the absence of any structural liquidity to the left. Whereas if I wanted to get long here, we'd need to build some liquidity with break structure. We have early enticements, people looking to get long, for example, something like this. We then sweep below this, take all those premature early buys out, and then get our entry criteria and then get long. So this is kind of an example of what I mean by building liquidity to the right. And so in terms of targets for this, of course this is the first target, but I'm actually anticipating this to fail based on this box. So just below. And then of course I'll monitor to see how we get, how we start reacting, if we start building something to the right, and then I'll trade accordingly or manage accordingly. And so I'll just play through price. So the order was on at this point, tagged us in this case you can see where it came to the top flip zone in the end, which is why I wanted to cover it in the first place. I'd rather be in the trade safely than, try and scrape a tiny stop loss together and be, maximizing the risk reward. I actually want to just be in the trade consistently. I'm not too bothered about having 1 pip stops kind of thing. I'd rather just be in the trade and be safe. And so we can play this down, chops around a little bit, comes into our zone. Okay, and now the key thing is, are we building liquidity? Are we manufacturing anything to the right in terms of structural liquidity to entice early buyers into the market? And so like I said, if we were to come down like this, for example, and we had this push up here, it's very unlikely that people will be enticed to buy at an area like this. No one's really going to be interested in looking for longs here, but a slight difference is if this did this and we had something like this, had this break of structure, now we've got enticements, now we've got levels of demand which have broken structure, enticing people into the market here. but based on the fact there's no structure to the left here, this would then be considered to be early enticements. And so we have all of these early enticements here, and I'd expect this low now to be taken to then get the original move to then continue like that. And so this may look a bit like that because we do have this low, this high, this low, and we might consider something like this where we have this change of character like this, and then we might consider this to be structural liquidity to then continue below. So if we sweep this, for example, then get an entry, then look for longs. But the difference between this and actual structural liquidity is the fact that structural liquidity should be a break of actual structure, not wicks below structure. So it should be body closures. So for example, the actual 1 minute swing structures would be low, high, low. This is actually a failed lower high because it's failed to close below this structural low here. So we've not actually closed with a body. This isn't a lower high even on the 1 minute. The high would still remain to be here. And so in terms of 1 minute structure, we're still bearish. We're still just trending downwards at this point. And so the high is still intact, so we're still bearish. Now we've broken this low, which is fine, but we've not swept structural liquidity is what I'm getting at. And so I'll just put this on a little bit more. So now, if you did consider this to be structural liquidity being swept, if you had this as the structure, we had this as the liquidity grab, and we had this as last point of supply, and then our typical flip, we might consider, okay, why isn't this a good trade? Or why should I not be getting in this trade? It's perfectly valid, right? But it's just a slight little detail, a slight little difference in the fact we never actually broke structure. This low didn't break the swing high on the 1 minute. This was a failed lower high because it didn't take out this structure here, so this was still the high. This therefore isn't structural liquidity. This isn't a liquidity grab. And in fact, this would just be another premature entry. And so this again, I'm not willing to put my capital on the line there. And in fact, what I'll be looking at is this isn't structural liquidity like I mentioned. So the only available structure we have at the moment that is strong, that has broken something, would be the low itself. And so if I just draw this on here, you can see on the 15-minute, this is the 15-minute area of demand. Like I say, we haven't got any structure here. We haven't yet built any to the right here. And so the only option in order to grab liquidity would be for us to take the low itself. And this can then be a question of, okay, but has demand then failed? Technically, it would have traded through the demand if we were to come below here. But we can also consider, okay, what is the purpose of this failure? Is it to break demand and continue with the bearish trend, or is it, or the supply being in control and continuing lower, or is it just temporary to grab liquidity because it was the only available option? There was no available liquidity to take here, there was none available to take here, so this is the only available option to take liquidity if we were to continue pushing price from this area of demand, if demand is in fact to regain or take control of the market to continue pushing price. Because structurally we are bullish, we have broken this level of 15-minute structure here, and so it is a good area to look for longs potentially from this area, even if it is just short term, as a potential hedge for this original sell, or to have potential also if this is going to begin our higher time frame pullback. And so this is why I was kind of very interested in the longs here. So if I go down to the 1 minute again, like I say, I don't want to be getting involved in these premature entries. Essentially, I want to wait for liquidity to be taken and not enter in, like I say, the liquidity building stage. I always want to enter after liquidity has been taken, as it's a much safer entry. And so in this case, I'll just play price on a little bit. Okay, we've basically now grabbed this liquidity, and so the question now is, where is the last point of supply which caused price to trade lower? And so in this case, if we were to look at the structures, the 1 minute structures, I've had this low, this high, this low, this high, and then we've just pushed straight down one leg. And so if I just move this out of the way a minute, we can say, okay, arguably, people might consider this. But then what I'd say is, if we look at the low here, we've already traded through it already. And so the last point of supply I'd actually look a bit higher. And what I had was this area just here as the area of supply which caused, you know, the last break here. So if we were to consider looking for longs, I'd want to see a reaction to this and then demand taking control, and it would be a valid trade because we'd have essentially swept liquidity. We know 15-minute is bullish. In this case, you might ask, why have I waited for this level of respect of supply, and why wouldn't I need to see the level of respect for this? And the key difference is just coming down to 15-minute trend. 15-minute is bullish. We've broken this 15-minute structure here, so that means sells, even though we've got the supply chain and so on, sells are technically counter trend to the 15-minute structure, whereas buys from here are actually pro trend on the 15. And so if I just go down to the 1 minute again, we say we've grabbed this. Last point of supply, I'll just play pricing a little bit. We've essentially reacted to this area of supply, extreme of reaction leg, failure. And so we can see that supply has now failed, and I'm happy to get long from here without the fear of potentially coming to the extreme, without the fear of, you know, using this here as inducement, price coming lower and then potentially doing something like this. There's no fear or doubt in terms of where I want to enter here because of the fact we've already taken liquidity. Liquidity has already been taken, and so I only need to enter on the flip zone itself and don't need to worry about further inducement. And so this is essentially the liquidity grab here. So also say that it's a V-shaped recovery. So we've traded down, traded back up with severe momentum. We've now had this shift. This here was my entry somewhere around here. And so I'll just play price on a little bit. And so in terms of management, like I mentioned before, the main target really with this one was to trade below this structure here because of this box. And so the majority of this trade came off below this low here. But obviously I left some volume on just in case we wanted to follow through with the higher time frame bearish trend. And so now this essentially is a hedge. And now in terms of targets for the hedge, it was a little bit trickier because we don't really have a clear direction, because we can say the 15-minute is bullish, the 4 hours clearly bearish. Go back to the 4 hour. The 4 hours clearly bearish, and we're kind of reacting from this 4 hour zone here. And so in terms of management for the longs, it was a little bit difficult, but the main thing what I wanted to do is just get the risk off and see what it did basically. And basically what I decided to do was just take the majority, same way here, with these being hedges for the original shorts, I wanted to take the majority off. I believe it was a 15-minute zone. I believe it was here, essentially following the supply chain. So we had this mitigation here, push down here, and then this then being the next level of supply. I took the majority off in and around these areas here. But I'll just play pricing a little bit. So we kind of started reacting to, you know, some 1 minute levels to the left. I'm not a big fan of looking at 1 minute levels all the way up and down each leg. It's more a case of looking at 15-minute levels and then using the 1 minute levels in and around the POIs themselves, or to the right, so to speak. But in terms of like marking out all these zones here, I don't really want to be looking at all these 1 minute levels. This is the 15-minute level I was looking at. Risk is off on this trade now. And what we can see with this push, we have this clean push with no structure within this leg. So that's just something to note. And I think there was some people trading some things here, which is fine, but there's nothing really that I'm interested in at this point. So we came back down, we essentially remitigated my entry, we remitigated this demand. So we can say demand is almost confirmed now. Like I said, I didn't wait for the original level of respect. This is essentially that now. Even though I'm already in the trade in this case, we've now had this demand showing that it's holding. So we know demand is in control. We've swept liquidity to the downside here. V-shaped recovery, supply and demand interaction flip. Demand held again. So demand is clearly in control. And so looking for potential scalings long are actually on the cards now. And so if we were to do that, we can see, okay, there's no structure available to the left here. And so what do we know? We know we need to build some to the right. Otherwise, the expectation would be for the zone itself to be taken similarly to this. And so if we just continue pushing on a little bit more, we can say that we kind of have these levels of respect to the top side here. So we have this, basically this supply chain, this mini little supply chain that's kind of forming to the upside. And all it's essentially doing is the same thing I mentioned a bit earlier. When demand is in control and we have these supply chain mitigations, we're essentially building liquidity for higher prices. In the same way when it was the other way around. For example, where was it? Supply was in control here and we were getting reactions from demand, essentially building liquidity for lower prices. And so if I was looking to get long from here, at this point in time, I've not had an entry criteria, right? So what we can see is we have this 1 minute break. What have we not had? We've not had liquidity taken to the left. We've not had liquidity built to the right here. So we need liquidity built post mitigation. Where is the available liquidity? Where is the interaction between supply and demand? In this case, it was kind of messy. There was kind of these areas of supply, although it wasn't really too clean. But if we were to look at it, potentially this would have been an area of demand which essentially caused the break of this. So this is a nice area of demand. But what I want to see is liquidity being taken before I get involved. And so we could potentially induce this, we could potentially induce this. But what I want to see is I want to show me what it wants to do. I don't want to set a limit right now. I want it to show me what it's going to do. I want to see the liquidity taken and then give me a setup. So we'll kind of just build in these equal lows. Again, it would be valid potentially to, if you want to set a limit, you could do below here, below this inducement, because you could say this is liquidity being built. This is the area to get long. But like I said, I want to see it. I want to show me liquidity being taken and then give me a setup afterwards. I'll just play on a little bit more. Okay, so we've now grabbed the liquidity below here. We've essentially respected demand here. We've respected demand here. And so we've essentially grabbed liquidity. Last point of supply which caused price to trade lower than these structures would be here. So we have our typical flips, we have our reaction point, the extreme of the reaction leg, and then the failure. So let's take this back a little bit. We're essentially reacting to this level of supply. We then fail, or we break above the reaction point itself. And so now it's valid to look for trades. You can either use the wick itself, or in this case, if it's kind of close together or the wick is small, I like to just use both. And so then my next entry, or my scaling, I think it was a 2.2 pip stop, something like that. Basically, it was a market execution because it kind of happened fast, so you had to react fast. I think it was 2.2. So I've got in somewhere around here, market execution. And then we continue to push to the upside. And so, like I said, we had this liquidity built here. This was kind of the same target as the original trade. Of course, we hadn't hit this yet, but I was risk-free. And so the same thing with this, majority off at this area here, and then it's about which way is it going to follow through, because I'm in the short, obviously majority is off. If we do get to this area here, I'm in the longs, but majority is off, and so then the price can just show me whatever it wants to do. I'm happy either way. So yeah, we hit this target here, and it takes me out of the short, unfortunately. and it just trades above here, and then shortly after that I think it takes me out of the longs too. Yeah, so but this is why I like to say pay yourself at logical areas. Like in this case it ran 10.3, in this case it ran 10.5, in this case it ran 6.9. You know, roughly, these might not be exact with these risk rewards right now, but pretty much majority was off below here, a majority was off in this zone, and then I kind of left price to do what he wants to do. But in this case, when price is not overly clear, for example, like the 15's bullish, the 4 hours bearish, it's just a way of still capitalizing on the market in terms of focusing on liquidity concepts, focusing on who's in control in terms of supply and demand, and just making sure to follow the same principles over and over again, and also remaining patient as well. There's no need to dive in kind of out of FOMO or fear that basically the price is going to go without you, because I mean sometimes it will go without you and you just have to accept that, and I'm happy to accept that because I'm happy to wait to get in the safer entries. If I'm going to put my capital at risk, I want to get in the best possible entries or the safest possible entries. And so for example like this, I'm happy not to set the limit here. Yes, it might just tap and go, but I want to stick to the rules in the sense of 15-minute is counter trend. I want to see the level of respect first and then get in. If it didn't give me another option to get in here and goes without me, it's just part of the process, part of the plan. Just let it go, and you know, await the next setup, which obviously doesn't take long trading this style. The next setup comes, and so in this case, now pro trend, we don't need the first level of respect. We've had the sweep of liquidity, we've had the supply and demand interaction, we've had the V-shaped recovery, which is nice. We get long. Again, we can see, ask ourselves, who is in control? In this case, demand is clearly in control. We're breaking supply, holding, breaking all these levels of supply. Demand is still holding, and obviously there's no liquidity yet, just in this case. But then we wait for liquidity to be taken. No need to jump in here, trying to jump in out of FOMO, seeing it's going up. Oh my god, it's gone, it's gone. No, it'll give you an opportunity to get in, and if it doesn't, it doesn't. It goes. It doesn't matter. It's just about trading the same way every single time, and whether like you trade the exact same way as me, or you know, any other coach or any other strategy. Basically, if you can do the same thing every single time without deviating from the plan, without trying to be in every single move in the market, you'll find it a lot easier to be consistent if you're just doing consistent actions, consistent style of trading, consistent routine, consistent everything, even down to time frames. I like to stick to the same 4 hour 15-1 as my foundation, and only ever go to other time frames if for whatever reason it's not clear. Like I don't like the idea of forcing time frames. So like, if okay, what's this reacting off? It's not reacting off anything on the 1 minute. I don't want to then go to the 2 minute and see if it's reacting to something, because it's just kind of forcing the trade. I'd rather just wait for the same criteria to be met every single time, if that makes sense. Now, of course, there can be cases where changing timeframes can help, but just for me, I just think as the foundation, at least, little things such as timeframes, such as same session, same pair, same entry criteria, same everything, just keep everything consistent, and I just feel like the results become more consistent a lot easier. Yeah, it's a little bit of a rant, I don't know why, but yeah, I hope I explained everything, you know, clearly and it makes sense. Like I say, any questions, just hit me up on Discord. But yeah, I'll talk to you soon, guys. Take care. Bye.